I'm going to talk today about what I think is a very important development in the capital markets, which in turn has important implications for corporate governance. It's particularly important to be having this conversation in Chile because while it is the phenomenon is going on in the United States and elsewhere, in many respects, Chile has thought more carefully about this, or indeed anticipated this issue better than any place else. So it's going to be, I think, an interesting conversation. The development I'm concerned about is the intermediation of the equity markets. That is, the process which is going on everywhere, and particularly in the United States, though there without thought, that equity holdings are increasingly being concentrated in record-holding institutional investors. That, in turn, cascades through the governance system in important ways, and that's what I want to talk about. In the United States and Chile become a fascinating comparison because in the United States, that intermediation is taking place in a system in which there are typically not controlling shareholders. And in Chile, the same intermediation is taking place through a system in which there are primarily controlling shareholders. So the comparison becomes very interesting. I should say two things about myself, mostly so that you know my background, because maybe there's a bias. I don't think so, but we're never all that good at recognizing our own biases. I'm the independent chair of a large family of mutual funds, and so I see the asset management business in part from the inside, as well as with my academic hat on. And on the other side, I've been, over the last 25 years, involved in a couple of different activist campaigns going back into the mid-'80s. Was Carl Icahn's first run at U.S. Steel, to more recently one of the losing efforts that Bill Pershing Square ran with respect to Target. So won one, lost one, but got to see both on the inside. So take that into account. There are a couple of things I want to get clear at the outset about the way I'm going to develop this. And they're basically just understandings about how I think capital markets and corporate governance relate to each other. Step one is that the capital market, its function is to transfer risk. When the company sells securities to investors, the investors get a piece of the future cash flows of the business, and the company gets risk capital, gets equity against which the business's risks are charged. Second step, how sophisticated the capital market is determines what kind of risk management, what kind of risk transfers you can do. The company can borrow, they can issue debt, the company can issue equity, and increasingly the company can use derivatives for the same purpose. An example, a railroad in Western Canada. Its sole business is to take the wheat that they grow in Western Canada and send it to Eastern Canada where the people are. It just takes a second to realize that the success of their business depends on the weather. If the weather is good, they grow a lot of wheat. The boxcars are filled going east. If the weather is not good, they lose a lot of money that year. They had a lot of equity because the equity had to cushion those swings in its business. 8 or 9 years ago, they realized that they could buy a weather derivative, the value of which was keyed to a reasonably complex measure of how the weather affected crop growth. They then repurchased close to half of their stock because they did not need, the risk that the equity was protecting against was transferred to the derivative market. Oh, that's even better, thank you. The shift to corporate governance then comes by recognizing that corporate governance is the equity contract. And what I mean by that, a little example. Assume two companies, same business, same risks, but they have a different capital structure. One has a great deal of equity, the other has a great deal of debt, and I want you to make an assumption with me, the value of the company drops in half. The red line. Now, for the heavy debt case company, if the company doesn't make its interest payments, we know what happens. We know where to look. There's a bond indenture, there's terms of the note, there's a bankruptcy code. The debt holders know exactly what happens at that point. But take the company with more equity. Drops in half, value drops in half, and the board of directors decides they're not paying, they're cutting back on dividends. How do the shareholders, the equity holders, know what they do in that circumstance? And the answer is the governance system. What corporate governance does by allocating rights, identifying the rights that shareholders have, it is the contract that governs their investment, their equity investment in the company. So, yeah. Last premise in the talk, the relationship between capital markets and governance is dynamic. It changes. What we're seeing in the U.S., for example, is the equity intermediation has fundamentally changed the nature of the U.S. governance system. How did it happen? Nobody planned it. It changed because of the way the U.S. decided to save for retirement, and it changed because investors began to understand that diversification was important. So when that happens, when the capital market changes, when it changes the ownership structure, a governance system that was geared to the old ownership structure begins to be unsuitable for the new governance structure. The equity contract begins to evolve in response to things that happen in the capital market. Last point, those transitions are almost always difficult for reasons that you will see, that you'll understand if you think about it for a second. People and institutions have stakes in an existing governance structure. The new governance structure may be right, but when you move from the old one to the new one, it affects people's interests, and things that affect people's interests tend to generate disagreements. Okay, so what I'm going to do today, I'm going to look at the impact. Start out by looking at the U.S. I'm going to look at the impact of intermediation on ownership, equity ownership in the U.S. I'm going to suggest that the U.S. system, which we tend to describe as a system of diverse shareholders, it's simply factually untrue. I'm going to describe the system we have, which I call agency capitalism. I'm then going to begin thinking about talking about a subject that bears much more attention to Chile. And at this level, I use the word speculate correctly because everybody in this room knows more about this than I do. But I know enough to say this is a very interesting question, because the same forces, the equity intermediation, that are rolling through the United States and changing governance dramatically are playing out in Chile, in part on purpose, except they're playing out in a system which have controlling shareholders. And the outcome is different and in a lot of ways much more interesting. So let me start with the U.S. There's a standard account of U.S. corporate governance. Mike Klausner talked a little bit about it. There are lots of diverse shareholders. There are no controlling shareholders. The company in this account is managed by professionals. It's very nice. They're specialized because now talented managers don't have to have their own capital in order to run a big business. And the equity is held in this account by small diversified shareholders who are also specialized because they can hold by holding diversified portfolios. They're the cheapest provider of capital. In that account, the role of corporate governance perfectly straightforward. There's a potential conflict between the professional managers and the professional risk bearers, and governance is designed to align everybody's interests so management works for the shareholders and the like. In 1950, that was an accurate description of the U.S. system. About 5% of the stock was held by institutions. That changed. It didn't change on purpose. And one of the things, looking ahead to talking about Chile, one of the things that an outsider observes looking at the Chilean structure is while this went through the U.S. without anybody thinking about it, to an outsider, it looks like the Chileans in Chile, people thought about it a lot. So what happened? Right after World War II, there was a real political fight between one group of people, largely the labor unions, who wanted retirement to be provided by government payouts, much like the European system, and the business community, who wanted company-based pension plans because they wanted those funds to stay in the capital market where they could access it. The company-based plans won. Second thing that happened, starting in the mid-'80s, was the beginning of a shift that by now is overwhelming from defined benefit plans to defined contribution plans, the difference of which is pretty straightforward. Who bears the risk if investments don't work out? Defined benefit plan, the company bears it. Defined contribution plan, the workers bear it. The participants bear it. The result has been a shift into intermediation. Lots of money going into asset managers like mutual funds. Now, what does that actually mean? I'm going to show you two slides that have some numbers. I'm not sure how easy that is to read, but it basically shows the percentage of the outstanding stock of different cohorts of American public corporations held by institutional investors. In the top 1,000, so the largest top 1,000 U.S. public corporations, on average 73% of the stock are held by institutional investors. If you move up to the top 50, it's almost 64%. These aren't diverse. This isn't small diversified shareholders anymore. Now, the truth is, this doesn't tell us enough. The woman who, Sarah Teslick, was the founding executive director in the U.S. of the Council of Institutional Investors, and she said something that was both funny and profound. She said, saying that someone is an institutional investor is like saying they're a brunette. It's true. It just doesn't tell you anything about them. So the next slide is just a quick effort to say a little bit more. So this is the 10 largest U.S. companies without an explicit controlling shareholder. We can fight about Microsoft being on there. And this is the percentage of stock held by the 25 largest institutional investors. Let's take Apple. This is 2009, almost 40% of Apple's outstanding stock was held by the 25 largest institutional investors. That number has gone up over the last couple of years because of Apple's success. Wells Fargo, close to 45%. ExxonMobil, fighting with Apple to be the largest cap company in the world, you're still at 25%. What it effectively means is that in a standard boardroom, which will typically hold 25 people sitting around the table, there are 20 representatives of 25 institutions that represent effective control of virtually every major company in the United States. That's not a diversified shareholder base. Now, these institutions are different because, remember, they don't hold the stock as beneficial owners. They hold it as record owners for the beneficial owners who are investing in their funds. And that's what I actually mean by agency capitalism. And here's my effort to be artistic with PowerPoint, which typically fails. So here's the old received wisdom. Pretty straightforward. There were managers, there were shareholders. In between it was a potential conflict of interest. The new world. They're managers and the record holders, and that's the same potential conflict of interest we've always had. Except between the institutional record holder and their beneficial owners, there's a different conflict. Because between the institutional holder and the beneficial owner comes the institutional owner's own business model. And as we'll see, that has an impact as well. So what we see is the beneficial owner, that all of us who are investing in the mutual fund. We're rationally passive. We don't read this. We don't read the disclosures. We own too small a share of the stock to make it worthwhile for us. For many investors, if they read the annual report on Form 10-K that a U.S. company sends out, that's 200 pages long. One, they might not understand it, but putting that aside, by page 60, they'd fall asleep. So the fact that they don't pay any attention makes perfect sense to them. Institutional investors are different. And I'm going to suggest to you that they're rationally reticent. They're reticent in the sense that they will tend not to be proactive, but they will respond carefully to other people's proposals. And there's somebody at the table who knows more about the business model of large asset managers than I do, but I've looked a little bit at it. There's to understand, at least in the U.S., two things. One is that what drives the movement of assets among asset managers is relative performance, not absolute performance. Because increasingly, what you observe is advisors and Morningstar and you want to do asset allocation. Right, you want to identify which sorts of risks, and you want to choose one from an investment, one from column A, one from column B, one from column C, and the inclination is you're going to choose the best performer. Put aside how in the world you actually measure that, but you're going to choose the best performer in each of the categories. So relative performance, how you do versus your peers, drives assets from one asset manager to another. The second part of this, my really simplified characterization of their business model, is that there are enormous economies of scale associated with managing money. So at any given point, I mean, there'll be lumps, but at any given point, if I pull another $1 billion into my funds, the margins on that additional $1 billion are spectacular. It's the best part of the business. So there is a real incentive to perform. You don't need a 20% carry in order to persuade a big asset manager to perform. They're doing better than 20% given the margins. And so, in one example, mutual funds. they hold directly about 30% of U.S. equities. But they also manage private money. So if you throw the special accounts in, they probably represent close to half. They're probably, in effect, voting close to half of the equity capitalization in U.S. companies. So here they are, 50%, right? If you look at all of the shareholder proposals that were made over the last couple of years, mutual funds made less than 1% of them. And even the 1% overstates it. Those were proposals made by special mutual funds that are market themselves as environmentally sound or socially responsible. Perfectly sensible thing to do, but the proposals were to not do business here or animal testing or the like. So that for corporate governance purposes, they're kind of beside the point. However, when other people made proposals, staggered boards, real governance proposals, mutual funds quite frequently vote against management's position, and every mutual fund has their voting principles on their website. So when the issue is teed up to the institutions, they're quite serious. They're quite serious about their role. So, let's see, let's skip this. The upshot is institutional investors then don't have much incentive to proactively address performance or governance issues. If I'm a portfolio manager and I discover before everybody else that there's a governance problem in a company or a strategy problem in a company that's affecting the value of their stock, I can do two things, right? I can engage in governance activity that will cause the company to change their behavior. And that'll cost me something for a large fund. You know, the percentage of a basis point that will cost, there are a lot of zeros after the decimal point before you get to 1. But if it works, the benefits get shared by everybody, which is to say it doesn't affect the relative performance of the mutual fund that figured it out. The alternative is, if I think there's something bad going on that affects the value of the stock and nobody else but me knows it, it means the stock price is too high relative to that information. So I affect my relative performance by selling the stock before everybody else figures it out. That's what fundamental analysis do. My portfolio managers are supposed to be doing that. The result of it is that governance rights, in effect, are undervalued. The ability to proactively affect the governance of the corporation isn't assigned the value that it otherwise would, because the record owners, the institutions who could exercise it, don't value them. They'd rather sell. Not because they're lazy, but because it makes the most sense given their business model. What we've seen happening in the United States is the development of activist investors. Bill Ackman and Pershing Square is a good example. Carl Icahn's doing things like that. Much more common. And the model is, I buy the stock at the low governance price. That is the price that does not reflect the ability to cause the company to change its strategy. And I don't tell anybody I'm buying it. I then use the governance rights that, in effect, I bought cheap in order to change the strategy of the company. You know, just a standard arbitrage model. There's a piece of property, the governance rights, that are trading lower than they're worth. I buy it. After I buy it, I make the issue public. I go to the company, Sometimes the company decides that I really have a good idea, and they do it. Other times they don't. If they don't, then I run a proxy fight. It works or it doesn't. Ackman ran a proxy fight ultimately to change the management of one of the company of the second two large Canadian railroads. I don't know why I'm focusing on Canadian railroads today. The one he was looking at chronically underperforming. It went to a shareholders vote. Overwhelmingly, the shareholders voted to replace management. The price of the stock has gone up dramatically. On the other hand, and I'll use the same activist because it reminds you that not all of anyone's ideas are always right. Ackman does the same thing at JCPenney. And he has what seems like a great idea. It's an old, tired retailing, sort of low-end retailer. He hires the man who basically invented the Apple stores. Right? Apple stores are the highest per square foot grossing retailer in the world. What a great idea. Well, the guy knew how to retail things that cost $2,000 a pop. He didn't know much about selling clothes in a retailer, and it was a disaster. And Ackman and people who invested with him lost a lot of money. So they're not always right. But the nice thing about the structure is they can't do anything, an activist can't do anything themselves. In the end, it requires, if the company doesn't agree, it requires a proxy fight, which means the institutional investors have to decide that they're right. By and large, the activists, on average, end up owning about 8% of the stock when the proxy fight starts, when they announce it. The 8% is enough for them to make money. It's not enough to win an election. To win an election, the institutions have to vote for them. And the way those votes take place, everybody goes out and talks to the institutions. The activists, the company, 300-page PowerPoint decks, and the institutions are more than sophisticated enough to understand it. After all, they have portfolio managers whose very purpose is to evaluate strategies. Where this ends up in the U.S., the favorable characterization is you end up with a kind of stewardship. The EU feels very strongly that institutions should act like stewards. And they tend not to think about the fact that stewardship is contrary to the institution's business model. It's really hard to get people to do things that aren't consistent with their business model. But the combination of the institutions and the activists together turn out to be a kind of market stewardship that seems to be working. The only trouble is, and remember I said that when there are transitions in governance, they tend to be controversial because somebody loses. There are a set of proposals, and some having gone further in the EU, essentially to restrict the activist business model, to require disclosure earlier, to include derivative interests like total return swaps in the calculation of what they hold to identify the trigger, all of which are designed to protect management against activists. It's a bad idea, but it's not. It's hardly surprising. And I mean, so that's a fair description of where the U.S. governance system is today. A change in the capital markets, a change in how ownership is held, and that change then cascades through the governance system. Now, the part where I'm going to be speculating, and that is talking about Chile and other controlling shareholder systems. Now, something that has been mentioned a number of times already this morning, the tension in a controlling shareholder system is very different than in the U.S. It's not between managers and shareholders. The controlling shareholder will do a perfectly good job of monitoring performance, it's private benefits of control. There's a tension between controlling shareholders and minority shareholders over the extent to which the controlling shareholder has the power and then sometimes acts with that power to divert more resources to themselves than they ought to get. So I want to start the speculation with a premise. And it's an analytic premise more than a factual description. I'm going to start with the premise that minority shareholders initially are dispersed. Small shareholders invest in the stock market. They're minority, but they lack just as we discussed with the US, they lack the incentive to monitor or the capacity to act on their own because they hold too little. And the reality is, even if there's a really effective court system, won't make much difference in that world because court litigation is expensive. And unless there's a method to finance that litigation, even having effective courts with that distribution won't matter. Recall Mike Klausner said most claims in US corporate litigation are filed with one form or another of a contingent fee. The shareholders are not bearing the cost. I'm not trying to advocate that system. I'm just describing that if small shareholders have to finance the litigation, it's not going to happen. Okay. What it ends up doing, it puts a lot of pressure on the regulator. So in a good system in this world, you speculate the regulator is going to be more active. Now, when that happens, you end up with minority shares trading at a pretty familiar discount. If there's a bunch of empirical evidence, minority shares in controlling shareholder systems mostly trade at a significant discounts. It differs from country to country. In Italy, before some reforms, trading at about a 43% discount to control shares. Mexico was over half. Think about it. In each of those two systems, close to half the value of the company was getting diverted, or at least the market thought it was getting diverted. It gives rise to two puzzles, one of which I think I know the answer to, and the other, or at least the right question, the other to which I don't. The question I think I know the answer to is, in that world, why do minority shareholders buy this stuff? Well, short answer, if minority shareholders know how much is going to be diverted, it's a fair game. Right? If there's a cap somehow on diversion, I can estimate that, I can value the securities, and then I've paid a fair price for it, it's fine. Pass for a minute we'll come back to how you have an effective cap on it. The puzzle that I don't know the answer to, but people in this room may, the fact that the minority shares are trading at that discount means that when a company sells shares into the market to raise capital, they're paying a very high price for the capital. They're selling their future cash flow at a discount. Why finance growth with an instrument that's got built into it the size of the discount that it has? And I don't have any real intuition about that. You could say people go public for liquidity purposes. If in effect I can charge a controlling shareholders 50% in order to get liquidity, it's a business I want to be in. So there are other ways to do all of these things. I just don't understand entirely what's going on. So here's the speculation. Equity intermediation, when working through a controlling shareholder system, turns out to shift the system from one in which there are lots of diverse minority shareholders into a minority blockholder system. And of course, that's the point at which the Chilean experience begins to seem so prescient. The role of the mandatory pension funds. And it's interesting, the same phenomenon, the need to save for retirement, drives the process in the US, drives the process in Chile, except Chile dealt with it differently. And the little bit, these numbers were what I could find in a really quick look, and so they're probably out of date, and I may have misunderstood them, but it looks like the funds now own about 7% of total equity, about 25% of the float. Again, my reading of the system at a distance, it looks like the institutional structure that Chile has devised provides an awful lot of support for a minority block system. Cumulative voting, you only need 12.5%. Well, maybe no single fund owns 12.5%, but as I understand it, the AFPs by law are explicitly allowed to coordinate an election, something institutions cannot do without a lot of regulatory frictions in the U.S. Putting an independent boardroom director in the boardroom, as the Chilean directors commented in the first session, they know things. The process becomes more transparent. So whatever else happens, if there are bad things going on, it's far more likely that we'll find out about them if there's somebody else in the room who in fact is independent. I gather the AFPs are allowed to coordinate. They have to vote for independent directors. There are standards, education standards and the like for independent directors. And of course, the other important thing, it's a system, again, looking at it from a distance, which is designed to help institutions participate in governance. And it may make an awful lot of sense if you're designing a system to do that, if the capital market in Chile doesn't have the liquidity that would allow institutions to really dump the shares of stock of a company that they all own, because they have to sell to somebody. If there's not liquidity in the market, you better participate, because the option of selling without significantly depressing the price may not be there. So a question that Mike Klausner repeatedly asked me, terrific, you've got minority block holders, but the important word in that phrase is minority. How do they actually affect change? If litigation is effective, that'll work, because the ability to cooperate may allow joint funding of litigation, things like that could happen. And then there's informal enforcement. We can call it reputation, but reputation sounds like it doesn't require any structure. And I just want to suggest that reputation is important, but the structural features of the system can help reputation work a lot. So if you think about what it takes to make a reputational market work, to shame well, the bad behavior has to be visible. Somebody's got to be able to see it before you can embarrass people. And begin to think having an independent director in the boardroom makes that a lot more straightforward. The objections have to be clear. That is, they have to do things that everybody understands is a bad thing until their shame. And then the punishment has to occur in a different market. It's got to affect either their ability to raise money through debt, affect their participation in the product market. I would rather rely on market punishment through reputation than just ego. So reputation, these informal enforcement mechanisms seem to me as potentially very important, particularly the smaller the business community is. Denmark has something similar, but it takes an institutional structure, I think, to support it. So predictions, and The one I feel reasonably confident of is the equity intermediation is going to continue to increase simply because it makes economic sense. Aggregating minority shareholders' investments is a much more efficient way to run the capital markets. The wild card in systems outside the U.S. is the growth in funds, the growth in asset managers. That is the U.S. and the UK has seen this happen more thoroughly and faster, but there are people like BlackRock who are working really hard to expand the asset management world outside the United States. So, what do we predict? Prediction I have is that you're going to see very different patterns in different countries, and it's going to depend on the institutional structure. If minority block holders are supported by the structure, are able to elect directors, are able to operate effectively, you're going to see the minority discount go down in those countries. That is, the value of the stock will go up. There will be other countries where the amount of institutional support for minority block holders will be less significant, and in those countries the minority discount will stay high. So you'll begin to see a differentiation, a continued differentiation of those discounts country by country depending on the local conditions in that country. Now that's everything on this page is a hypothesis about which you all have more experience than I do, and the panel has more experience, so I'm going to stop and listen to people who actually know something about how this works.